Scan for Sovi and straight A's only. Let's go!
Central banks can change everything with one move. Let's quickly solve this macroeconomics problem about interest rates and exchange rates to find the right answer. Lowering the interest rate on reserves makes holding money less attractive for banks. This encourages lending, which increases the money supply and lowers the nominal interest rate across the entire economy. Lower rates trigger capital outflow as investors seek higher returns elsewhere. This increased supply of the local currency causes it to depreciate, while lower rates simultaneously boost investment and aggregate demand. Higher aggregate demand pushes real output and the price level upward. Combining these effects, we see that option A is the only correct choice. Well done! Scan the code. You can learn better with Sovi. Watch signs to avoid a rush. Trust given data and check steps.